Hello, everyone. Welcome to today's webinar. I am Nikhil from Efficient Capital Labs, ECL. I will be the moderator for today's webinar. We're very happy to have Qapita hosting us, ECL, for today's webinar. We have two leaders today from both Qapita and ECL on the webinar who will be speaking about broadly financing options for B2B SaaS startups. Without further ado, I would like to invite Ravi, who's the co-founder and CEO of Qapita, to give us a brief introduction and kick off today's webinar. Over to you, Ravi.
Good morning, good afternoon, good evening, depending on where you are. Hello, everyone. It's a pleasure to have Qapita host this webinar together with Efficient Capital Labs. Qapita and Efficient Capital Labs have known each other for a while and have had the benefit of interacting with the leadership and with the team there. Our business is to do with cap tables and ESOPs and equity management. And in that process, we have a ringside view of what happens with capital raising, what happens with equity capital raising, how you can be more efficient. And sometimes people also at early stage startups, you use equity compensation so that you conserve on cash. And so everything to do with capital structure is at the core of our business, and we have a ringside view given what we do. So we thought for our customers and audience related to that, this session will be really useful. Given Manish, Nikhil, and the ECL team will talk about different forms of financing. This is topical. This is very relevant to our customers and the audience, and therefore it is our privilege to have Manish speak a little bit more about efficient form of financing. I think today's session will focus on B2B SaaS startups. That business model presents itself uniquely to what Efficient Capital Labs does. I was looking at some stats. I think there are close to 2,200 SaaS companies, Manish, now building out of this part of the world. I'm based in Singapore, and our business is in Singapore, India largely, and we're just expanding into the US market. And we see a large number of companies building SaaS solutions from this part of the world into the global market, and the US becomes the largest part of that market. So I think what you have to share and what the value that ECL can add to B2B startups will be immense. And so without taking much further time, I will hand over to you and look forward to hearing from you on this topic.
Thank you so much, Ravi, and hello to everyone who's joining us live on this LinkedIn. First of all, I'm grateful to the team at Qapita and to you, Ravi, that you're investing your time in this topic, which hopefully will be beneficial to everyone who's logging in today. And you talked about having a ringside of the capital structure of the companies, and the fact that what we are going to discuss today is so topical. Just yesterday, I remember I saw a post which was originally from one of the Qapita competitors, which talked about how this year has been the highest number of down rounds for the last 5 years, I think, if not historically. I don't remember exactly what the stats were. So I think given what you do, the kind of access that you have to what companies are going through, it's really sort of a unique view that a company like Qapita gets into the sort of the pleasures and sorrows of companies trying to raise capital. So we are very glad to have this opportunity to partner with you and to share with everyone who's on this LinkedIn Live our perspective on B2B SaaS funding. Sorry, Nikhil, you are on mute.
Thanks again, Ravi and Manish, for setting context for today's webinar. For all those who are already on, do remember that you can post your queries live on LinkedIn Live, just type it in there. We will try our best to answer in real time, but I assure you, all questions will be answered. We have a good 55 minutes to go. So we have more than enough time. We want this to be interactive, so please don't hold back. If there's any question, do post it, and like I said, either we'll answer it immediately, but definitely after the presentation. So with that, I'm going to now quickly present, Manish's deck. And Manish, let me know.
So while we are waiting, Manish, we are a B2B business, and we are also a majority of our business is also the SaaS model. So along the way, I'll be wearing my B2B founder hat and ask you a few questions as well. This is just for my curiosity and learning as well.
Yeah, absolutely, Ravi, and I'll do my best to do justice to those questions.
Yeah, also broadly for those on the webinar, we have a fairly wide coverage. We'll be going through, starting with the types of capital that are typically available to startup founders, whether you're considering equity, debt, a combination, the impact of external financing at each and every stage of a startup's growth cycle, very important for all founders present today and all leaders. Implications of the ongoing funding winter, I think we're all aware of that. It's ongoing for sure. And how does that impact a startup's growth cycle? And finally, by virtue of both Qapita and ECL being here, ECL's core offering, which is revenue-based financing for SaaS startups, and we have certain special offers for Qapita customers, which we will talk about as well. All right. How does this look?
Yeah.
Yes, that's perfect, Nikhil.
Okay, super. All yours, Manish. I'm going to the next slide.
Sure. Thank you, Nikhil. And once again, thanks to everyone who's joining this LinkedIn Live. Over the next 10-15 minutes or so, I'm going to talk about a perspective on SaaS funding. And essentially, this perspective is formed on the basis of three different lenses that we have adopted to look at the SaaS funding. So two of these are from a macro perspective, as in a big picture perspective. So macro supply side perspective and a macro demand side perspective. And the third lens is from a micro perspective, as in how should an individual SaaS company founder think about SaaS funding. And essentially what we present here is these are the kind of things that you should consider, the questions that you should ask yourself. Each SaaS startup is different based on where they operate, how they operate, whether they are a horizontal SaaS or a vertical SaaS, and so on. So there is no one size fits all, but broadly what we feel are like these are the things which apply to a typical B2B SaaS companies. And I'm hoping that the questions that we present to you for your sort of food for thought, they're going to be pertinent regardless of the kind of B2B SaaS startup that you are. Nikhil, if we could move to the next slide, please. So I want to start by asking a question. Given the format of this, I'm not expecting to see any answers come to me in real time, so I'll also answer the question. But essentially, the first thing that I want all of us to think about is what is common across these three activities: car racing, bungee jumping, and entrepreneurship. Now, I'm sure, as you reflect on it, maybe there's more than one thing, but probably the easiest to see across these three activities, the common thread that runs is that these activities are risky, are what we would call as a risky activity, as in there's always a possibility of something going wrong. So that's what is common across these activities, and that's how we should think about entrepreneurship. And I'll come to why this is relevant from a capital or a fundraise perspective in a moment. Nikhil, if you could please go to the next slide. So we talked about the three activities being risky. So what do we mean by risk? Risk is simply the possibility of something bad happening. If you are doing bungee jumping, maybe you don't have the sort of stomach for it, and maybe you kind of go through a panic attack as you do it. If you are racing a car, God forbid, you might have an accident. If you are doing an entrepreneurship, you may create a business, but it may have to be shut down. It may not be able to raise capital and so on. So there's always a possibility of something bad happening. That's true about any risky activity as such. Uh, Again, the reason this is relevant, you will see it in a moment. Nikhil, if we could please go to the next slide. So when we think about payback on risky activities, and let's bring this in the context of entrepreneurship also. So what's the payback on entrepreneurship? The payback on entrepreneurship is the thrill that you get, maybe if you're talking about intangibles, the fact that you get to make the world a better place again in terms of intangibles. But when it comes to tangibles, it's really the wealth that you create for you and everybody else who kind of became part of that uh, journey into unknown with you. And if we have to think of a simple framework for how to think about payback on these key activities, so essentially it's a very simple equation. The first part of which is your skill or luck, recognizing that both the things can play a role in the success. So how skilled you are, how lucky you are, and then how much of leverage you got. Leverage, very simply, is how big a bet you got to play. So essentially, if you think about these two things as the independent variables, then interplay of these two will create payback for you as an entrepreneur, as a founder. So again, always think about the payback on your activity as a function of these two things: skill and luck, which is your capability, your luck with timing, your luck finding right people at the right timing, right time, right customers, and so on. And leverage, how big a bet are you able to kind of place, and that's what your payback is. Nikhil, if you could go to the next slide, please. Now, this slide is really, really important, and this is what, especially if you look at the word since the global financial crisis of 2008, this is what has really happened. Uh, and there's a little bit of financial theory in this, hopefully not too complicated for people to appreciate. But essentially, what do we mean by risk, particularly in the context of capital markets? Risk is measured typically by the interest rates that you have in the market. And essentially, what we are saying here is that doesn't matter which risky activity we are talking about. If you artificially limit risk, leverage becomes more important than skill or luck. For instance, if somebody gave you a boon that no matter what kind of driver you are never going to have an accident, then all that matters is what kind of car you have if you are doing car racing. Similarly, if you are doing bungee jumping, if somebody told you like nothing will go wrong, you won't have a panic attack, the rope won't snap, and so on, all that would matter for the thrill or the adventure that you get is how long the rope is. Similarly, what happened in the capital markets is the risk pricing, which is nothing but the interest rate. They were artificially low for a very long time. In fact, I don't know if there's a way to substantiate this, but because because of the assertion that I've read, that interest rates were lowest for the last 5,000 years. I don't know how somebody would say that, because I don't think we have the record going back 5,000 years. But to the extent that there's been, there is some historic evidence of how people raised capital 5,000 years back. The last 15, 16 years were really extraordinary, as in the risk was artificially limited. We had zero or near zero, what is usually known as by the acronym of ZIRP, zero interest rate policy, in much of the developed world. And because the cost of capital globally is kind of determined by how the developed world prices risk in the financial markets. Everywhere we had a sort of abundance of capital at very low rate. This thing, of course, got exacerbated during the COVID times because not only the interest rates were low, but also there was a liquidity situation where government essentially gave away a lot of money to people so as to support the economy. But essentially, that's how you got to think about last 15, 16 years, that it was an extraordinary time in which the risk in the capital markets was artificially limited, and that's how leverage became more important than skill or luck. Nikhil, if we could go to the next slide, please. So we talked about funding winter at the beginning of this session, and here's how I think we should all look at funding winter. Funding winter is nothing but leverage becoming relatively less important than how it has been in the last 15, 16 years. And it's coming in line with historical averages, as in, it's not the way to kind of think about it is that what we had in the last 15, 16 years was extraordinary. The funding winters is actually like how things probably have been for much of our economic history. And there are sort of two good reasons why you should think about it. Is one, it kind of uh, prepares you for a world where the capital may not be as abundant, and two, essentially you will see like recognizing this will also help you kind of prepare uh, your business in a way that it's not kind of as dependent on leverage as businesses in the last 15, 16 years have been, because those businesses are only viable at a sort of super global scale. And business, particularly a B2B SaaS business, doesn't have to be that way. Nikhil, if you could move to the next slide, please. So this is exactly what I've said, that the greater systemic appreciation of risk is a net positive for entrepreneurship. When there's a greater systemic appreciation, it reflects itself in terms of slightly constrained availability of risk capital. And essentially what it does is it kind of helps entrepreneurs who are like really, really enterprising and really skilled stand out from entrepreneurs who may not be that skilled but may have access to capital for some reasons. So in a way, whenever you have greater systemic appreciation, you are actually going to have companies with better sort of fundamentals, better unit economics, outshine companies that are kind of just built on a foundation of a lot of capital, and who need to sort of who are viable only at a sort of super scale of, I don't know, tens of billions of dollars, and below that they are not viable as a business because they have kind of inflated their fixed costs to a certain extent that makes it very hard for these businesses, to be viable below that scale. Uh, Nikhil, if you could go to the next slide, please. Okay, so that was a supply side perspective, and if you have to remember one takeaway from that section, just remember that funding winter is nothing but leverage becoming less important, and on the whole, better appreciation of risk is a net positive for entrepreneurship and for you as an entrepreneur. So I'll move on to the macro demand side perspective. Again, this is a big picture perspective from a demand side, how SaaS companies should be thinking about needing capital, wanting capital, raising capital. So if we could move to the next slide, please. So if you think about SaaS businesses, then most SaaS businesses, they don't operate in winner takes all markets. Uh, what this means is like, sometimes SaaS businesses can have some sort of network effects, but even then, it's not a winner takes all space. And this is something very important to recognize. And essentially what this means is there are a lot of SaaS businesses. It also depends on whether it's a horizontal SaaS or a vertical SaaS. You could argue that horizontal SaaS is also not winner takes all, but it will probably be able to get to a much bigger size. But a vast majority of SaaS businesses, for instance, in the beginning of this session, we talked about like 2,200 companies, SaaS companies, which are there. Sort of that maybe good, uh, 95% of the companies, the ones that are profitable. So I'm not even talking about like the ones that are sort of viable, let's say, in the next 5 years. So we are not even talking about companies like that may go out of business, but even the ones that are successful and so on, even they will mature at 20 to 50 million ARR, which is not a bad outcome per se, because SaaS is, generally speaking, a very high gross margin business, because the incremental cost to produce your next product that you can monetize, next unit of product rather, that you can monetize is zero. So essentially, it's a high gross margin business. So even if you are at 50 million ARR, you could easily have, 25, 30 million of that as your gross margin, if not higher. But that's a reality that most SaaS businesses will experience. And then the final thing is that given the nature of SaaS, most SaaS businesses can find a capital efficient playbook to grow because it's not a winner takes all market, because the revenues will plateau at some point. Uh, it's imperative as well as possible to find a capital efficient playbook to grow. So these are the things which I would want any SaaS business to kind of ask them. It's different, ask themselves, like when they are thinking about fundraise, like what is the market in which we are operating? Is it a winner takes all market? What is the realistic plateau for our revenue? Where will we plateau? And is it possible for us to find a capital efficient playbook in order to grow by looking at companies which are in similar space or companies who have been there and done that? Like, is there a capital efficient playbook for us to grow? So these are the things that I would want any SaaS business to ask themselves. And of course, the answers to these questions will be different for each business that goes through this exercise. If you could move to the next slide, please.
Sure, Manish. So while we're on this, just wanted to involve Ravi as well. And Ravi, I
Sure.
know Qapita itself is a SaaS business, but I know you have a lot of SaaS customers as well. So, and you've seen a lot of this play out. What are your views on what's just been shared?
Yeah, I mean, I can only agree with these, and these are great insights. And I will also add that depending on where you are, which geography you operate, not all SaaS businesses are built across all geographies. So the 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 plateau therefore can be real and sooner for some businesses than others. And Manish mentioned horizontal and vertical. So there is also the geographic element to this, and therefore finding efficient playbook is almost mission critical. It's a matter of when and not if for most businesses, and that can be sooner in some cases. I think that's the point, and we it's the same for us. Actually, our engagement with Kaustav and ECL also developed around this topic and curiosity to understand how this can be relevant for our own business. So, agree with the proposition here, and also think that it can be. The sooner we kind of figure out more efficient form of funding the business, the better it is for everyone, and effectively to all stakeholders too in the business.
Sure. Thanks for that, Ravi. And just as a reminder for everyone who's on the webinar, on LinkedIn Live, feel free to post your questions. We will be wrapping the presentation in a few minutes, and then, more than happy to answer your questions together.
Thank you, Nikhil, and thanks, Ravi, for your perspective. So finally, we are at a micro perspective. So this is how an individual entrepreneur, an individual founder, an individual company probably needs to think about fundraise. If you could move to the next slide, please. So essentially, any startup goes through two pivotal dilutions in its life, right? A startup always starts its journey with a dilutive event, as in the seed fundraise, and it ends it with another dilutive event, which is essentially exit. At each of these stages, you are kind of, as a founder, selling your stake to someone. And these are like very important dilutive events in the life of startup. And one could argue, like, if they don't happen, then most startups will probably not be viable. So these are given for most businesses, particularly the ones that want to succeed in a more tangible way for the founders, for the other for the team, for the founding team, and for the employees. These two dilutions are a given, uh, a pivotal sort of stage in the business, or in the pivotal stage in the journey of any business. If you could move to the next slide, please.
Sure. Also, while we're on this, very quickly, also wanted to involve Ravi. So, just so you know, for everyone on the webinar, incidentally, about 20% of ECL's customers are actually bootstrapped, right? But we acknowledge that a majority of startups do go through, multiple rounds of funding sooner rather than later, and spreading, like I said, right from seed to exit, as Manish has mentioned. And this brings us back to Qapita's core offering, which is very much around, SaaS, cap table management, ESOPs, and so on. Clearly there are multiple rounds that could happen, and when you go closer to an exit, whatever the form of that exit it may be, founders need to keep a tab on just how much dilution has happened over these multiple rounds, and what the impact is, not just for themselves, but all the shareholders, all the stakeholders, on the cap table and so on. So that's, I think, something very relevant for both Qapita as well as ECL.
Yeah, absolutely, Nikhil. Uh, there's dilutive event at the start and at the end, like Manish mentioned, and along the way too, in terms of milestones, the whole seed, Series A, B, C journey, and you know. An alternate form of financing or an efficient capital structure may actually assist in terms of how you manage the dilutive milestones along the way too, and almost is necessary and critical. And actually looking forward to the next few slides from Manish, from the micro and the company perspective.
Sure.
Okay, so what is success in more tangible terms? Success is optimizing the path that is taken between these two dilutive events. And the keyword here is optimizing. It doesn't mean having only two dilutive events in your journey as a startup. It's just that you optimize the path. You dilute when you need to, you dilute if you need to, you dilute only as much as you need to. And you kind of understand that your journey as a founder, very important part of that journey is making sure that the path between these two dilutive events, which are almost a given, is as optimized as possible. And that's really what success boils down to, very simply. So Nikhil, if we could please move to the next slide. Uh, yeah, this is, if you could move to the next one, please. Yeah, so here's a summary of what we just discussed, just a recap of all three perspectives. So from a macro perspective on supply side, what we are going to see is sustained reduced supply of risk capital. This is, in my opinion, bit of a readjustment and not seasonality. When we use terms as funding winters, it implies seasonality because winter goes away and then spring kicks in a matter of few months. But this is probably a slight readjustment, which will be more secular and not just seasonal, in terms of the impact that it has on the capital markets, particularly for early stage risk capital. From a demand side, what I think we would like to see in the market, and what we already see talking to a lot of SaaS founders, is there's a greater appreciation of lower serviceable, obtainable markets. I think Ravi made a great point earlier that you know, there's verticalization, as in you may be operating only for one kind of industry, and then there's a geographic limit also, which kind of lowers your serviceable, obtainable market, because you may theoretically be able to cater to the whole world, but realistically, you may only be able to sell in a particular geography. So I think there will be greater appreciation of that. And also the fact that leverage in its own is not differentiation. You know, we have had things which apply beautifully to some kind of scenarios. For example, blitz scaling. It applies to businesses with real network effects, such as LinkedIn or Facebook, etc. But it doesn't apply to a lot of businesses. And for those businesses, when they raise a lot of capital, while they get bigger leverage, but that doesn't necessarily bring any differentiation, which is valuable from a customer perspective. So I think there will be a greater appreciation of that. And because of this, there will be lesser external capital raised by these businesses. And from a micro perspective, what we see already, a lot of our customers kind of thinking, doing, and also we feel like increasingly we'll see more of that is there will be a greater optimization for cost of capital. And essentially, what that means is you kind of bring in the right kind of capital at the right time. You don't want capital at, I don't know, 25%, 28% IRR coming in from a VC sitting in your bank account if you're not going to invest that, or if that's not required for the business that you are at. You will, as an entrepreneur, probably evaluate a lot more carefully what is the cost of capital that I'm incurring, and am I able to create value which justifies that cost of capital? Because essentially, what you want to be able to do is to create value at a rate which is higher than your cost of capital. And if you are not able to do that, then you should not be raising capital. So that's our perspective in a sort of more composite, summarized way based on the three perspectives that we have adopted. I think we have one more slide in the back, Nikhil, right? Yeah. So I think, given that we introduced ourselves, so I won't spend a lot of time on this, but very quickly you might wonder, like, okay, what do we do as a business? Even though we introduced ourselves at the beginning of this session, but just a quick recap: we are Efficient Capital Labs. We are in the business of providing 100% non-dilutive capital to B2B SaaS businesses. We can write a check up to $2 million in less than a week. We provide funds through our own debt facility. So we are not like a platform where we connect supply with demand. We are the supply ourselves. We have served 100 plus SaaS companies till this date, maybe around 115 by now. And we are backed by top investors. And I think this is a really important point because we are not anti VC. We ourselves are funded by VCs. We have raised 3 rounds of dilutive capital. And what this really goes on to say is like the idea is not to say no to dilution. The idea is to kind of understand, okay, do you need dilution? And not everything in the business lends itself very well to dilutive capital. And similarly, not everything in the business lends itself to non-dilutive capital. So we ourselves have diluted our stake like 3 times so far. And the two top investors in our business, one is QED, and the other one is 645 Ventures, who both sit on our board as well. So I'll pause here. Back to you, Nikhil.
Thanks for that, Manish, and thanks for your views as well, Ravi. While we still await, any questions coming through from the audience that's watching here live on LinkedIn, again, just wanted to reiterate that this webinar has been hosted by Qapita, inviting our strategic partners, which is Efficient Capital Labs, today to share not just our offering, but also by virtue of our partnership and the fact that we've been working together for over a year now. There is a special offer that is available exclusively to Qapita customers if they were to go in for financing via ECL. So, Manish, would you like to share that a bit more? And of course, post webinar,
Yes.
this will be shared, but just for the purpose of the audience today.
Yeah, sure. So as I mentioned to you earlier, we can do disbursements up to $2 million. So based on how much is the amount that we fund you for, we have two different offers for customers who would want to also sign up to Qapita, and that's something which we would recommend if you don't already have a solution for managing your cap table. So in case we fund you up to $250,000, what we'll do is we'll cover up to 1250 $1,250, or 50% of your annual Qapita subscription fee. And in case the funding amount is more than 250K, then we'll be able to support you with your Qapita subscription fee of up to $2,500, which is like the 100% of your subscription fee for Qapita. And essentially, what you do when you kind of sign up for this offer is you are managing two problems in a single go when it comes to managing your capital related problems. You are kind of on a more sort of operational logistics stakeholder management level. You are getting top tier cap table management SaaS platform, and also you are getting capital which will allow you to solve not just your problems related to paying for your software, etc., but also given that we do up to like $2 million, it can be a pretty meaningful kind of injection of funds which you can use for your go to market strategy, maybe enter into a new geography, maybe make those key hires that you have been waiting for, or maybe just kind of timing your next round of fundraise a little more opportunistically, grow your ARR, and then go to the capital markets for equity raise in another 8 months, 9 months. So together, Qapita and ECL can solve a lot of problems for you.
Uh, Let me jump in here. Manish and Nikhil, thanks for this offer. I think it is quite an attractive and generous offer, and appreciate the partnership that ECL has with Qapita. Just want to add that close to 2,300 companies use Qapita software already. And my understanding, Nikhil, please correct me if I'm wrong, this is extended to all of existing customers of Qapita as well, who may want to partner with ECL. If any of our customers of Qapita can reach out to ECL, in addition to anyone evaluating a cap table or ESOP management tool. I have a few questions, Manish, but I will let Nikhil guide me in terms of when to bring them up.
No, go for it, Ravi. I think you can go for it. Yeah.
Manish, it'll be useful, at what stage and what stage of companies, all of these questions are critical ones for founders and CXOs of various startups that may be considering these solutions. So it'll be useful to give a guidance on, what's a typical stage at which this kind of solutions make sense, and what are you seeing from, and there is a distribution, of course, there's a range, but it'll be good to get a sense of that.
Absolutely. So I think a way to think about this in a more conceptual way, and then I'll come to it in a very simple sort of heuristic kind of way that also you could look at answering this question. In a conceptual way, you kind of think about this is that, okay, if you have got a problem that you don't know how a dollar that I blow into my business will be turned into, I don't know, something more than a dollar. If that's your problem, then essentially you got to raise equity, okay, because you are not sure about like how you will solve that problem, which is nothing but maybe a way to kind of say that, okay, you haven't really figured out market yet. You are not sure about what product exactly you will take to the market. You are not sure about the demand for that product, even at a sort of relatively small scale. But once you are at a stage where you kind of figure out that, okay, for every dollar that I blow into the business, uh, I'll get maybe $1.20, $1.25, right? Which is nothing but a way of saying that, okay, you have found a little bit of product market fit. You know that, okay, I spend a dollar, here's the leads that I generate using it. Then I go through that, time of converting those leads into paying customers. There will be a period where they will evaluate our solutions, and then maybe in 6 months' time, maybe in 8 months' time, maybe in 9 months' time, they'll actually become a paying customer. Obviously, not every lead becomes a paying customer, but on the whole, if you put a dollar into your business, you get something, $1.25, $1.30, or something in your business. Now, once you are at that stage, you should really ask yourself, whenever you are thinking about diluting, that what is the reason I am diluting? Am I diluting because there's a limited opportunity that I have, which will go away? If I took 2 months to go after, 2 years to go after that opportunity, it won't exist. I only have like 3 months, 6 months to go after that opportunity. It's a time bound opportunity, or maybe for some other reason you want to kind of go after it. Otherwise, if you if you're already, let's say, a business at, I don't know, $2 million, and if you think like your realistic sort of plateau is $20 million, but the path to get there is, I don't know, 10 years of growth at not an unimpressive rate, because even to go from 2 to 20 million in 10 years, doing sort of rough mathematics in my mind, I think you'll probably need to grow at sort of mid-teens along the way each year, which is more than the rate of inflation. So it does require some growth, but not crazy growth that you have. Uh, then maybe what you could think about is, instead of raising equity, because you got time on your side, you got like 10 years to get there, and that's where you want to be. You think about, sort of raising non-dilutive capital. You retain the ownership so that when it's a $20 million company and it's generating $10 million of profits at that scale, out of those 10 million, a greater percentage accrues directly to you. Right, so that's a conceptual way to kind of think about it. Now, a simple heuristic, a mathematical way to kind of think about it is like, typically what we see are companies that have found at least, annual recurring revenue north of 300, 400K. They are able to kind of enter into sort of non-dilutive capital related commitments, which essentially is a commitment that, okay, they get money upfront, but then they have to pay it back in a sort of 12-month, 15-month, 18-month cycle. So typically businesses which are north of 300K, 400K are they like this kind of product. The use cases, they change based on the stage of each business. So maybe a 300, 400K is using businesses using it to kind of time their next fundraise a little better. Maybe a $2 million ARR business is using it to kind of skip equity raise altogether. So it depends. The use case depends on the individual company. And if I have to again give you an idea, like most of our customers, maybe a good 50% of our customers will be between 1 million to maybe $10 million, $15 million ARR. But we do have like the smallest customer that we'll have, maybe they'll have ARR around 120K or so. And the largest customer that we have, they are probably north of 20 million also.
That's super comprehensive, and that's a relatively wide range and quite relevant to our customer base, and also the kind of companies that Capita seeks to serve. Manish, I have a couple of questions as well. You mentioned less than a week. It will be good to give a sense of what kind of system or system level data or data requirements you will have to
Yeah.
facilitate that, and also from a to be are there any requirements from a business maturity or business performance perspective that you will have, or use of proceeds?
Yes. It's a great question. We are a revenue-based financing player. So essentially, the amount of funding we give you is going to be a function of your revenue. Now, how do we look at that revenue? We essentially look at it from two quantitative lenses and one qualitative lens, and I'll explain each of these. So one quantitative lens is in terms of cash flow, which is essentially seen through your bank statements. So how do you kind of, get your cash into the business? And for that, you talked about what systems we use. So essentially, we have integrations through which we can connect with most banks in the US, which allow us to read the bank statements of the customers programmatically and essentially categorize them and understand very quickly that, okay, these are the payments coming from customers, these are the payments going out for salaries, these are the payments that are going out for compliance related expenses, and so on. So that's one sort of quantitative lens that we adopt, and the access to that is through bank statements, which is a programmatic access. The second quantitative lens is through financials, which is essentially like, okay, what does the company have on its balance sheet? What does the company have it on its income statement, cash flow statement? And there, typically, we look at the last 2 years of financial statements. Again, to answer your question related to systems, this is also like we are integrated with most accounting softwares. So we are able to get this access programmatically also. The third lens, which is a qualitative lens, and essentially what we do there is we want to understand, like, qualitatively how strong, how predictable your revenue is. And for that, what we'll typically do is to look at your top 5 revenue generating contracts. And essentially, that allows us to understand like how sticky the revenue is, uh, how predictable it is, what kind of counterparty risk exists for this particular business, and so on. And that these two quantitative lenses and the qualitative lens of looking at the contracts allows us to form a holistic picture of the business, which allows us to determine, okay, what's the right level of funding for this business, which is non-dilutive in nature, because non-dilutive capital comes with a precondition that you are supposed to kind of pay it back at regular intervals. So what you don't want to do is, give an amount of capital for a business which is not prudent for them. So too little will also not help. Too much also will not help. So essentially, using these three different sources of data, we are able to determine what's the right amount for the business. The whole process, as you said, Ravi, it takes like 7 days, assuming that we get everything that we need in a timely manner. And then we send out a contract to our customers, which is actually anybody who's gone through equity raise and spent legal fee on that will appreciate that our contract is like not even 8 pages long. It's a very simple contract. You don't need to spend any legal fee when you go through this contract. And once you sign the contract, within 24 hours, you get the money in your account. And in fact, even that 24 hours, we are trying to kind of optimize right now. So we'll probably, in the next 3-4 months, we are right now working on instant 24/7 disbursement, which means like you sign the contract, and as soon as it is signed by both the sides, within the next 1 hour, you will have the money in your bank account.
Understood. And any conditions or requirements on use of proceeds, Manish?
Typically, what we see is like, given the other things that I mentioned, like the typical ARR, etc. While uh, there's we have funded businesses that have been and let me also explain you the context a little bit. Sometimes there are businesses which are on paper not very old. For example, somebody may have started something as a proprietorship, and then they saw potential in it, and then they incorporated it as a company, for instance, right? Or somebody may have been doing something part time, a little bit informally or on a platform, and then they figure out, okay, they need to take this directly to the market. So more important thing for us, we don't want to create a bureaucracy around it. And I think there's a customer that we recently funded who was not even in the business for like 12 months, but they had a meaningful revenue. So the more meaningful sort of yardstick for us is the annual recurring revenue as opposed to the vintage of the business. Having said that, given that looking at the last 6 months bank statement is such an important part of our process, I would, unless there's an extreme, and I mean extreme in the most positive sense situation, I would doubt if we'll be able to fund many businesses who are less than 12 months uh, in the business.
Got it. Understood. Nikhil, I just want to pause. I have one more question for Manish, but I'll just pause and see if you have any questions from the audience.
Sure. Ravi, do go ahead. I think the audience can still continue to post questions on LinkedIn Live. But for
Okay.
now, I think we're good. So please go ahead with your question.
Yeah. Manish, if you can briefly touch upon, like, as a founder, we come across multiple forms of financing. Of course, equity we talked about. And in this specific case, it's revenue-based financing. If you can compare and contrast with respect to venture debt or, traditional debt itself, I think it'll also.
So that's a great question again. I think, and there's a reason why we don't call ourselves debt capital, because in our industry, it's typically misunderstood as venture debt. So I'll focus on like how exactly venture debt is different from us. First of all, venture debt is not 100% non-dilutive in nature. Venture debt always comes with warrants, which are dilutive sort of products. Maybe the dilution is somewhere around, based on how much debt you raise and other conditions, maybe you will end up diluting between 0.5% to 1% of your business. But a precondition for venture debt is like typically because there are warrants involved, the company has to be sort of it has to have raised VC funding, and because there are warrants involved, so there must be another dilutive event also when those warrants become sort of more marketable securities, if you like. So that is one big difference. Now, of course, the venture debt process itself takes a long time. It's somewhat subjective in nature. It's kind of a due diligence process. The legal fee, closing fee, and all of venture debt can be quite high. Uh, Typically in the US, if you are doing a venture debt round, you could easily end up spending like 30, 40K on legal fee. uh, just to put it in context, like if we give you $1 million, the overall fee for you will be probably, like again, just to give a benchmark, maybe 110,000, 120,000 over a period of 1 year. So here, what you are doing is just on day zero, you are paying a fee of at least 50K, regardless of the amount that you have. And the other important thing, which is really, really important about how our product is structured versus venture debt, typically when you raise venture debt, you will raise it in a single tranche to cover your kind of cash needs for the next 24 months. So essentially, what will end up happening is that you are raising capital from the markets and then parking it in the best case to some money market account, where you will get maybe 4-5%, and the overall cost of capital for you could be, I don't know, easily like high teens, including dilution and everything in it. When you work with us, you don't have to do it in that way. For example, a business doesn't need it only needs so much money in the next 3 months, 6 months. So what you take from us is what you need in the next quarter, maybe 2 quarters. But then you come back to us and you only pay for that, and then you come back to us after 3 months, 4 months, 6 months, whenever you need capital, and we give you some more capital, and you are never paying a high cost of capital just for that money to be parked in your bank account, which gives you 0%, or a money market account, which gives you like 3-4%, unnecessarily, just because the product is kind of so stifling in terms of its features that it requires you to raise the entire sum of money in a single go. So that's the other key difference. Now, you talked about like other forms of debt which are available. Again, a lot of debt funding that happens with B2B SaaS companies, with businesses, is secured lending. Unfortunately, for B2B SaaS businesses, because a lot of assets are intangible in nature, intellectual property, etc., they don't qualify for very many such options. So that's a challenge that they face when it comes to other sort of debt options from a supply perspective. And even these businesses, like I'm talking about the lenders here right now, they one is there is because there's no asset, they are not able to do secure lending, and secondly, because they don't have the expertise in underwriting the revenue, or whatever else you want to kind of build your financing decision on. For SaaS businesses, they are not able to cater them very well. We specialize in serving B2B SaaS businesses. We have kind of developed the capability to kind of understand these businesses really well, which is something which is helpful for our customers, because it allows us to appreciate them holistically, and allows us to fund them in a very timely manner, and to a very meaningful amount as well.
Got it. I think that's clear. Thank you, Manish.
Thank you, Ravi.
So once again, I would like to, on behalf of ECL, thank Qapita for hosting this webinar for your audience. Thank you, Ravi, for kindly giving us your time and engaging with uh, ECL's co-founder Manish as well on today's webinar discussion. We hope this presentation and the discussion has been useful for everyone who has logged in, everyone has watched, and of course there will be follow-ups. This will be available for viewing online. And of course, as has been mentioned, there is a special offer by virtue of a strategic partnership for all Qapita customers. That's the 2,000 plus, across geographies, um, and that's something we'll be sharing in further detail with you going forward as well. So with that, I would like to once again thank Qapita and Ravi for hosting us, as well as ECL and Manish for this very insightful discussion on financing for B2B SaaS startups that we've had today. Thanks once again, and look forward to taking this partnership further. You will hear from us as a follow-up of this webinar.
Thank you, Nikhil and Manish. It's both we are both privileged and grateful to have this partnership and this session, which was quite good learning session for me as well, and I'm sure it is for the audience, and for the attractive offer to all of Qapita's customers. Appreciate it. Thank you.
Thank you, Ravi. Thank you, Nikhil, and thanks to everyone who invested their time in this LinkedIn Live session. Thank you so much.